Selling your commercial property, that should be a moment of pure victory, right? But here's a thought that can stop you in your tracks. Up to 20% of your hard-earned profit could go straight to the tax man. It's a pretty daunting idea, but listen, it absolutely does not have to be a reality. In this discussion, we are going to unlock the playbook of strategies that you can legally use to shrink or, in some cases, completely wipe out your capital gains tax bill.
And we're able to have this really important discussion today, all thanks to the brilliant experts at Pro Tax Accountant. These folks live and breathe UK property tax, and they've shared their top insider strategies with us to help you navigate these often tricky waters. So just know that all the insights you're about to hear come directly from the pros who deal with this stuff every single day.
Okay, let's make this real for a second. Forget all the abstract tax law. Just imagine you're a small business owner, maybe in London. You've just sold the workshop where you've poured your heart and soul into building your business for the last decade, and you've cleared a £100,000 profit. I mean, that is a fantastic achievement, a real testament to your hard work. But just as you're starting to dream about what to do with that cash, you get that nagging feeling. The tax man is waiting.
And he's not waiting for a small slice of the pie. You see, for a higher rate taxpayer, that £100,000 profit could land you with a tax bill of nearly £20,000. That is a fifth of your gain just gone. It can honestly feel like a penalty for being successful. But here's the crucial thing I want you to remember. That number is just a starting point. It's the figure for someone who doesn't know the rules of the game. Stick with me, because we are about to change that.
All right, so before we dive into all the clever tax-saving hacks, we've got to understand our opponent. Capital gains tax, or CGT. Think of it like a game of chess with HMRC. You can't possibly win if you don't know how the pieces move. So getting these fundamental rules down is the absolute first step to playing the game, and playing it well. So what is this thing really? Well, simply put, CGT is just a tax on the profit you make when you sell an asset that's increased in value. Now, for the 2025-2026 tax year, the rates for commercial property are 10% if you're a basic rate taxpayer and 20% if you're a higher rate taxpayer. And here's a quick did you know for you. These rates are actually a lot lower than the rates for selling, say, a second home, which can be as high as 28%. So it's a small mercy, but as we've seen, that 20% can still pack a really serious punch.
At first glance, the calculation looks pretty simple. You take the price you sold it for and you subtract what you originally paid for it. But crucially, you also get to subtract any allowable costs. And this right here is where most people go wrong. They forget things. We're talking about your solicitor's fees, estate agent costs, even the cost of capital improvements you made, like building an extension. After all that, you get to deduct your tax-free annual allowance. So let's say your profit was £100,000. Your annual allowance is £6,000, so your taxable gain is now £94,000. At that 20% higher rate, your tax bill is £18,800. You see how quickly it adds up? But don't you worry, because this is where the reliefs come in and completely change the picture.
And that brings us to the most powerful part of our chat today, the reliefs. Now, these are not loopholes. These are official HMRC-approved tools. They are specifically designed to encourage business owners like you to grow, to reinvest, and to plan for the future. Instead of just handing over a massive chunk of your profits in tax, this is your essential tax-saving toolkit. This slide just breaks down the two main paths perfectly. Your first big strategic question is this: what is your goal? Are you looking to defer your tax bill because you're planning to reinvest right back into the business? Well, that's rollover relief. Or are you looking to simply cut your tax rate because you're selling up or maybe retiring? That, my friend, is business asset disposal relief. They solve two totally different problems, so choosing the right one is absolutely key. Okay, so let's take a closer look at rollover relief. Think of this as the growth option. It's for active trading businesses that want to use the cash from selling an old asset to buy a shiny new one. The logic from HMRC is simple. They don't want to tax you on a gain that you're immediately putting back into growing the economy. The key conditions are right there on the screen, but that reinvestment window, that's crucial. Having 3 years after the sale to reinvest gives you a huge amount of flexibility to find the perfect new asset for your business. Now, here's a pro tip that genuinely surprises a lot of business owners. The new asset you buy doesn't have to be a like-for-like replacement at all. You could sell an old office building and reinvest all the proceeds into brand new state-of-the-art manufacturing equipment. Or you could sell a huge warehouse and buy a smaller office and a whole new fleet of delivery vans. This flexibility is what makes rollover relief so incredibly powerful for a modern business that needs to adapt and evolve, not just buy a slightly bigger version of what it just sold.
But what if your goal isn't to reinvest? What if it's to exit? Maybe you're retiring or you're selling up to move on to a completely new venture. This is where that second tool, Business Asset Disposal Relief, or BAD for short, becomes your absolute best friend. This is basically HMRC's reward for all your years of entrepreneurship. The main condition to watch out for is that you've owned the business for at least 2 years leading up to the sale. And be so careful with this. HMRC is incredibly strict on this 2-year rule. It's a really common pitfall where people sell just a month too early and miss out entirely.
So what is this reward for all your hard work? It's this beautiful number. Instead of paying capital gains tax at 20%, you pay at a flat rate of just 10%. Let's go back to our £100,000 gain. After your £6,000 allowance, your taxable amount is £94,000. Now, without this relief, you'd be paying £18,800 in tax. With BADR, you pay just £9,400. That is a saving of £9,400. That's a holiday, a car, a significant boost to your retirement fund, all straight back into your pocket.
So we've covered selling to reinvest and selling to exit, but there's a third really important scenario, passing the business on. Now, this isn't just a financial decision. For many, it's a legacy one, and the tax implications for how you hand over your assets to the next generation are absolutely huge. Stay with me, this next point might just surprise you.
This slide right here explains a key tool for succession planning called holdover relief. Let's say you want to gift your commercial property to your son or daughter so they can continue the family business. Now, normally, that gift would trigger a big CGT bill for you based on the property's market value right now. But with holdover relief, you pay nothing. The gain is held over, and your child effectively takes on your original cost. The tax only becomes due when and if they decide to sell it, maybe many, many years down the line.
But what happens if you don't gift the asset, and instead you pass it down in your will? This is where it gets really interesting, and it's a critical distinction to understand. When your heirs inherit the property, its cost for tax purposes is stepped up to whatever its market value is on the date you pass away. This means every single pound of capital gain that built up during your entire lifetime is completely wiped out for CGT purposes. It's an incredible benefit, but, and it's a big but, the property will then be part of your estate for inheritance tax purposes. This is a perfect example of why you can never look at just one tax in isolation. Now, beyond these core reliefs, there are even more advanced structures that can be used, especially for those of you with larger or more complex property portfolios. We're just going to briefly touch on 2 of the most common ones now, just to give you a sense of what's possible when you have the right advice. Let's briefly touch on 2. First, there's incorporation relief. This is for when your sole trader property business has grown so much that it really makes sense to run it as a limited company. This relief lets you transfer the properties into the new company without triggering a massive upfront CGT bill. Second, using trusts. This is a powerful estate planning tool. You could place property into a trust for your children, which can be incredibly efficient for spreading a future tax burden across multiple beneficiaries, letting each of them use their own tax allowances. Both of these are complex, and this is definitely get professional advice territory. I know, we have covered a lot of ground, and some of this can start to feel a bit complex. That is perfectly normal. The tax system is designed to be this way. But this is precisely why tax professionals exist, to navigate all this complexity for you. So don't worry, stay with me because we're going to pull all of this together into a simple, actionable summary. So we get to the most important point. What do you actually do with all this information? Let's distill everything we've talked about into a clear checklist that you can use as you plan your property sale. Okay, here is your final action plan. First, always make sure you use your annual exemption. It's a use it or lose it benefit each year. Second, ask yourself that big strategic question. Am I reinvesting or am I exiting? Your answer will point you directly to either rollover relief or BADR. Third, if you're thinking about legacy, start exploring holdover relief now, not when you're about to retire. Fourth, don't forget to offset any other capital losses. If you lost money on another investment, you can use that loss to reduce your property gain. And finally, and this is so critical, you have just 60 days from the completion of the sale to report it and pay the tax to HMRC. Please put that deadline in your calendar today.
And this quote on the screen really just sums it all up perfectly. The rules are there to be used, but they are intricate and they do change. Seeking professional advice isn't just about trying to save money. It's about making sure you do everything by the book, maximizing your reliefs correctly, and staying fully compliant. It gives you complete peace of mind knowing you won't get a nasty letter from HMRC 2 years down the line.
So, if you want to explore which of these powerful strategies is the right fit for your specific situation, the team at ProTax Accountant is ready and waiting to help guide you. You can reach out to them directly via WhatsApp or phone on 07985 689912. Again, that number is 07985 689912. Or you can always just drop them an email at info@protaxaccountant.co.uk. And finally, if you found this discussion valuable and you want to keep learning how to make these complex tax topics simple and actionable, I highly, highly recommend you subscribe to the Pro Tax Accountant YouTube channel. They are constantly sharing fantastic insights. Thanks so much for joining me today.